Hi everyone, it's Jack back again with another video. I'm going to do a 5-minute stock analysis today on Palantir, complex and secretive software company founded among others by Peter Thiel of PayPal and Facebook fame. October 2020 IPO, got a lot of hype. It's a very popular stock to talk about on YouTube. Basically cut in half from its high in September, still up around 40% from IPO, which is more than respectable. I want to figure out, is it investable at today's prices and is it investable going forward? So what does Palantir do? As I said, it's very complex. It's not the type of piece of software that you would run into in day-to-day life. It's best explained in Palantir's own words. We build digital infrastructure for data-driven operations and decision-making. Our products serve as the connective tissue between an organisation's data, its analytics capabilities and operational execution. Basically, Foundry is used by businesses, Gotham is predominantly for government, and Apollo is infrastructure for continuous software development. They help companies make complex data-driven decisions. These platforms can be relied on by the business for a ton of different functions, and this obviously creates big switching costs and therefore a nice moat, and this will only develop over time as these companies become more and more reliant. Looking at the growth picture, Q3 revenue grew by 36% to $392 million. Absolutely excellent. Year-to-date revenue grew to 44% to $1.1 billion. These are excellent numbers for Palantir. Still a relatively young company, doing really well. Landed a good number of multi-million dollar contracts this year with large customers. These are executed over many years. Slowly eating into the consumer market with the Foundry is really catching steam. Revenue can of course be a bit lumpy by the nature of this big contract win style of business. Crucial to Palantir is the removal of the overexposure to government contracts, which is slowly starting to eat into this year. Government contracts still make up around 56% of the business, and going forward they really need to make the majority of their business consumer deals. The reason Palantir can get away with this large valuation and why everyone's getting so excited about it is the adjusted gross margin. 82% gross margin, absolutely outstanding. This of course excludes stock compensation, which we'll get onto in a minute. 82% gross margin will be a crutch that this company can lean on forever, and why it will carry such a large valuation going forward. SaaS companies are famous for high gross margins. 82% is truly excellent. I think Palantir, as long as the gross margin remains this high, it will always be richly valued. That is just something people are going to have to get on board with. At current valuation after that big haircut, Palantir is only a $30 billion company. Total addressable market for Palantir was estimated, admittedly by Palantir itself, so take that with a pinch of salt, $119 billion. Less than 1% penetration as it stands. Trailing 12 months numbers are around 1.1 billion as you saw before. Current company forecasts have revenue growth of 30% for the next 4 years. Relatively reliable forecast actually due to the size of the contracts and revenue predictability of the business. If anything, this could be sandbagging because it doesn't actually include new business won. I think this is really strong. Stock-based compensation, as I alluded to before, is a frequently cited problem with Palantir. It's perhaps the main bear case of the company. It really is all over the place. Covers essentially all the losses. As the company grows, I hope this will decrease, and in my opinion it will not be too much of a concern in the future if it continues to decrease, but for now it is a bit of a concern, don't get me wrong. Q1 to Q3 2020, $1 billion, more than revenue essentially. Q1 to Q3 2021, $600 million. So this is a company that's doing $1.1 billion in revenue yearly, is getting out $600 million in stock-based compensation. Definitely something to be concerned about, definitely something to be aware of, but for me it's not investment case breaking. I think this will be remedied over time. You can see it's actually going down significantly. $1 billion for Q1 to Q3 2020 and $600 million Q1 to Q3 2021. Perhaps the IPO had something to do with that, but it's definitely coming down. And you can see, looking at the adjusted operating income at the bottom, when stock-based compensation is removed, they're actually quite profitable. $350 million profit in the Q1 to Q3. So you'd be looking at maybe $500 million for the year. That's a reasonable profitable company. So stock-based compensation is definitely severely eating into the operating income at the minute. Hopefully this will change in the near future. Looking at the debt situation and cash on the balance sheet, cash debt ratio of 9.43, excellent, absolutely nothing to be concerned about in my opinion. An Altman score of 18.12, safe and a company not in risk of financial default or in financial distress, so I'm completely happy with that. The valuations where Palantir is perhaps the second bear case is that it's even after a big haircut, it's still quite richly valued. Price sales ratio of 19, enterprise value to free cash flow of 140, forward PE ratio of 72. These are all, don't get me wrong, these are all expensive, but they are as cheap as Palantir has ever been. Absolutely excellent for Palantir historical value, and they are perhaps weak for the industry, but this is SaaS, like companies are richly valued. A lot of companies have took a real beating recently and valuations have came down. I think Palantir's valuation is still high because it is seen as such a quality business, and I think only time will tell if that's true or not, but I believe that Palantir's valuation is maybe justified looking at the 80% gross margin picture. So of course the caveat to all this is I am already a Palantir shareholder, so of course I think it's a strong company, and I think perhaps now is a good time to add to my position. The company is by no means a bargain, but a price sales ratio of 19. This is a company that grows 30% a year, long-term solid contracts, expanding use case in a huge total addressable market at 1% penetration, all at 80% gross margins. I think 19 times sales is kind of a reasonable valuation to pay. It's going to be profitable next year, depending on the stock-based compensation picture. It's already making a strong adjusted profit. I think has really strong moat due to the reliance companies develop on Palantir and difficulty switching. The obvious bear case outside of the valuation is stock-based compensation, which is all over the place. I believe this will come under control, especially over time, especially as the business faces pressure from outside investors to become more profitable. I think overall, I think Palantir is a great company that will be significantly larger in 5 to 10 years. I think now is going to be quite a rare buying opportunity with 50% down. So with that being said, hope you enjoyed the video, and subscribe and like if you're enjoying.